أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله صلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. Welcome to our last class on chapter 10. We have a lot to talk about today, inshallah, so let's get started. We stopped at the testing of internal controls. So we have three elements here. We have the testing of the inherent risk, the determining of the inherent risk, and then the testing of controls and determining the control risk. And then once we do that, we calculate the detection risk. If we have a higher detection risk, that means we have a low control risk. That means we have less substantive procedure to perform. Before we perform the substantive procedures, there is one small step, and that is called the substantive analytical procedure. Now, don't mix up the two. The substantive analytical procedure is not the substantive procedure. Substantive analytical procedure is something right before the substantive procedure. This is to take a pulse of the financial statement. So, when you go to the doctor, before you see the doctor, the nurse takes your pulse, your blood pressure, your temperature, your weight, etc., etc., asks you, are you in pain? This is not going to determine exactly what your illness is, but this is going to give an indication that there is some problem somewhere. So if your blood pressure is high or your temperature is high, something is wrong, right? So the substantive analytical procedure is looking at certain numbers or calculating certain ratios and so forth, and comparing certain numbers with the industry average, and comparing certain numbers with the prior period or the prior year's numbers to see, are they in line? Are they following the normal numbers, or are they out of line? So when you start doing this, you keep this in mind, that this is not going to give you any conclusion, but this is going to give you an indication. So what we do here is, for example, in the revenue process, in the revenue cycle, the first is receivables turnovers and day outstanding in receivable. What does this mean? You know, the difference between when the accounts receivable is recorded and when it's collected. So that's the turnover. How long does the customer take to pay the receivable after the customer has purchased the item? The fewer the days, the better it is. Every single industry has a norm. Maybe it's collected in 7 days. Maybe it's collected in 30 days. Every industry has a normal collection period, which is the turnover, receivables turnover. You want to calculate your client's receivable turnover to see, is it following the norm? And by being an auditor in a particular industry, you will know the norms. If the norms have changed, you will also know that, okay? So that's the first thing. The second thing is looking at the aging categories on the trial balance of accounts receivable. So the accounts receivables are listed as 30-day old, 60-day old, 90-day old, right? You want to make sure, and these are examples, it could be, you could have an accounts receivable listed as 120, 180-day old receivable. How old is the accounts receivable? There is a norm in the industry that you're in that the aging categories are 30, 60, 90, or 60, 120, 180, like that. Number of days the accounts receivable is. So you look at your client's aging categories and you compare that with what is the norm, what is the normal aging category for a business like this in this industry. If they are in line, then it's good. If there is something wrong, you make a note. If there's something out of line, you make a note of that and you keep that in mind. Bad debt expense as a percentage of revenue. Usually the bad debt expense is a small percent, let's say 0.25% or 0.5%, something like that, even less than that, of the revenue. And if your client's bad debt expense as a percentage of revenue is higher than the norm, that means maybe there is an error, maybe there is something wrong, right? The next one is allowance for uncollectible as a percentage of accounts receivable. So how much has the client recorded as an allowance for uncollectible as a percentage of accounts receivable, or credit sales? Credit sales are all those sales that are that have accounts receivable. Cash sales do not have accounts receivable. So you might not want to worry about the cash sales. You might want to just focus on the credit sales, which will tell you uh, how much allowance should be recorded. And this is calculated by your client. So you want to see whether their calculation is in line with other similar businesses, or their calculation is in line with what they did last year or the year before. So usually you're auditing the client multiple times. So you want to compare your current numbers with prior period numbers as well. And then you have the last one, large balances compared to the previous period. So if you have large balances, large bad debt expense, large accounts receivable, large allowance compared to the previous year, right? Then, and they have not opened as another location, or everything else is the same, right? Then you want to make a note of this. You want to make a note of all of these things before you go into the substantive procedure, and keep this in mind as you do the test of details to see whether you find additional information that will confirm that something is wrong. All right? Are you with me? Are you following? Are you following the idea of substantive analytical procedure? Okay. Now that we have done this, we jump into the substantive procedure. Substantive procedures. The first one is in the transactions. The first management assertion we're going to test is occurrence. Occurrence means the client says, the management of the client says, everything we have recorded has happened. So you vouch a sample of transactions from the sales journal to the sales invoice, customer order, and shipping document. What does that mean? The normal order of business is customer order or sales order, same thing. That happens first, then shipping document, then the sales invoice, then the sales journal, right? So this is what happens. The customer orders, you ship, then you send the sales invoice, and then you record this transaction in the journal. The client says, if you come to our journal and you find something that is recorded here, it happened. So how do you test that? You go backwards. So when you see the word vouch, it means go backwards. So you go backwards. You start at the sales journal and you pick up a journal entry, right? So you find in the sales journal debit to accounts receivable and credit to sales. And you want to see, okay, for this sales in the sales journal, do they have an invoice? Do they have a shipping document? Do they have a customer order? If they do have that, they do have proof of all of these, that means this particular sale transaction happened. So you're vouching, you're going back from the sales journal. Sales journal is the last thing that happens, but you want to make sure that it is not a bogus entry. So you go back. That's called vouching, right? You go back from the sales journal to all those documents to make sure that those transactions actually took place. Are you following? Is that clear? Okay. So let's take a look at one. Let's take a look at, for example, if we come to this journal right here, sales, right? As you see here, so we have a credit to North Supermarket, right? You see that $1,615, right? $1,615. Uh, the order of those documents will be evident from what? How do you know that the documents are in order? Date. Very good. So when you're looking at the document, you can easily look at the date. So we have here this sale recorded to North Supermarket. So we want to see if there is an invoice for this, right? So we go back, we see in the client records can we find an invoice, right? And can we find a sales order, and can we find a shipping document? So here you have a sales order. Do you see North Supermarket? This is December 5 date and 1615. So we see it. See it. Do you see it? Are you looking at it? Right? Do you see that? Okay. So now we have a sales order. Now let's see if we have a shipping document. Do we have a shipping document? Here we have a shipping document. What is the date on that shipping document? What is the date on the shipping document? Quick, quick, quick. What is the date on the shipping document? December 7, right? So is this before or after the sales order? Is this date before or after? After. No, this is after, right? Sales order was December 5. So you cannot ship before the order, right? You cannot ship before the order. So this is fine. Everything is good so far. Now we need an invoice, right? We need an invoice. Let's see if we can find an invoice. Here we have an invoice, right? The invoice is on the same date, so there is no problem. And it's for 1615. Do you see that? Do you see that? Right? Do you see that? Okay, so this is good. If we cannot find or we find some mistakes, then there is something wrong. So this is the first management assertion. The second management assertion is going the other way. So the second management assertion is completeness. When we test completeness, we are going in the other direction, and that is we start with the customer order, then we go to the shipping document, then we go to the invoice, and then we go to the sales journal. So this is called tracing. Trace means go forward. So here we start with the documents and not the transaction. We go to the documents, we start with the first document and we go forward, and if we find that in the sales journal, that means they have completely recorded everything. Do you follow? So this is the opposite. Occurrence starts, the testing of the occurrence is from the sales journal backwards. Testing of the completeness is from the shipping documents forward. Is that clear? Is that clear? The next is authorization and accuracy. Here we compare the prices and terms of a sample of sales invoices with the authorized price list. So what is a price list? Let's take a look at one. Let's take a look at a price list. The price list shows the items that the customers are going to buy from your client and their prices, right? So this is what a price list looks like. You see this? This is a price list. In this price list, okay, you see it now? The price list shows the items that the client has on sale. Men's formal pant $15, casual pants $12, etc., etc. So this shows the items that they're going to sell. What you're going to do is you're going to take a sample of sales invoices to see that the sales invoices are actually using these authorized price lists when they're billing. So let's take a look at an invoice. Let's take a look at the invoice of North Supermarket to see. You remember it's $15 for men's formal pant. So let's take a look at the sales invoice to see whether that is accurately recorded in the sales invoice. Invoice is the bill. So here is what we have, right? You see the men's formal pant unit price is 15. All right. So if this number was not accurate, that means there is something wrong. They have not used the authorized price list. And also, while you're at it, you calculate the 30 pants, $15 each. It's 450. So when you take a sample of invoices, you also check the accuracy for the calculation. So authorization as well as accuracy. Is that clear? Okay. So this is the third one. Checking the prices is not accuracy alone. Checking the prices and comparing them with the price list, you do both, right? So you make sure that the price list, the authorized price list, is where these numbers came from, right? So checking the authorization, as well as this is authorization as well as accuracy, because you want to make sure checking that is the right amount is also checking accuracy. And then while you're at it, you look at the calculations also. So if it's multiplied or added and things like that in the invoice, you want to make sure that they're accurate as well. Is that clear? So both of these assertions are tested at the same time. Okay. All right. Then we have the next one, which is cutoff. Here, we compare the date of the invoice, shipment, and recording of the sale. The way to do that is we take a few shipping documents just prior to and just after the year end to see that they're recorded in the proper period. So what we do, we come to the end of the year, last week or last couple of weeks of December, and we take a few shipping documents. And we want to make sure that those items are actually recorded in December in the financial statements. And then we come to January, the first couple of weeks or January, and we take a few shipping documents. And we want to make sure that those are actually recorded in January. So the periods are not overlapping. One period transaction is not going into the next one. Okay. Very easy to check. This is the easiest to check because you only have to worry about a couple of weeks before and after the period end. Even you can do 1 week because not a whole lot of things would get spilled over to the next period. Very few. You don't have to worry about the rest of the year because they should be in place, in order. Okay. Cut off. You're checking, making sure that the items are recorded in the proper period. Are you with me? Then you have the classification, which is take a sample of sales invoices and check whether they're classified as revenue. And while you are checking this, you want to make sure that the accounts receivable is also recorded in the right place. So you would go to the general ledger. Let's go to the general ledger where the sales are recorded, right? So here is the general ledger. As you see, sales. So we have sales recorded here. All the transactions are recorded here to sales account and nothing else, right? The sales, all sales are recorded in the sales account. And for example, we have credit to sales, North Supermarket, $1,615. We want to make sure that the debit of this is recorded in the accounts receivable of North Supermarket. So if we go up into the general ledger, we will find an accounts receivable of North Supermarket right here. So you have the accounts receivable of North Supermarket, and you see the same debit is recorded here, 1,615. Do you see that? So both of these items are classified in the right account. So this is checking the classification. So you take a sample of transactions from the general ledger, and you want to make sure that they are recorded in the right place. Is that clear? Are you following? Okay. Now, what you're looking at, what I'm showing to you, is the audit simulation uh, that we created here at Qatar University back in 2016, and we implemented that in class. We offered that to the students in 2016, 17, 18, and 19. So those 4 years, the students who took auditing 2 went through this simulation, and throughout this process, we asked the students to give us feedback on their experience with the simulation, what they found helpful, what they thought needed improvement, and we improved the simulation over 4 years. And last year in 2020, Alhamdulillah, it was published in the Journal of uh, Accounting Education. So this simulation is now uh, available globally to any accounting professor anywhere in the world to adopt to their classes, in their classes. Now, the sad part is because this is so involved, it takes a lot of time and guidance and so forth. And if I were to give you this and if I were to grade you on this without me being present while you do this, then uh, you might find it difficult and you might not be able to do that well. But I don't want to deprive you of this simulation. So I posted the simulation along with all the documents for those students who are interested to try it out, right? It will not be graded. And as soon as I say that, most students don't do that. And it's okay. But I am talking about that student who's interested to become an excellent auditor and not just pass the exam and pass the course. If you're interested to become an excellent auditor and accountant, which is my goal with you, then try the simulation. And if you have questions, difficulty, and so forth, you can ask me. And if you have a group of students, 2, 3 students, 4 students that are interested, and I wouldn't do it with any larger group than 4, let's say maximum 4 students. If you have more students interested, form another group and work on the simulation. This will give you the real experience. And just today, and this is subhanallah, qadr of Allah, that just today in the morning I received a request from a professor at University of Illinois, Urbana-Champaign. This is University of Illinois, Urbana-Champaign's accounting program is probably uh, one of the top, if not the top, accounting program in the world. So if if you do a PhD from Urbana-Champaign, for example, in accounting, you can get a job anywhere in the world, okay? And received a request from there, who professor who's implementing this audit simulation that we developed with the help of the Qatar University students in their class. I just received a request to give her the solution, right? So the solution is not published. The simulation is published. For the solution, they have to ask me or Dr. Nadir. The two of us developed this simulation over the period of years. And alhamdulillah, you see, we have this now implemented globally. I have received another request from another professor in the US from another good university. So the reason I'm telling you this is because the students who are graduating from here with this course and so forth, you see their quality is as good as any international university because this simulation is developed from the student feedback. We implemented it 4 times and the students told us this needs to be changed, this needs to be added, etc., etc., and this is where it is. It's your old elder brothers and sisters who did that, and you are inshallah bright as well. So don't think that you are anything less than any one of those other university students, right? So you should try this. And the reason I'm trying to tell you all of this is to motivate to try the simulation. It will upgrade you. It will take you to a different level. All right? Okay. Now, I have a link. This is the second part, right? So there are 2 documents. The first document will give you the instructions, right? The main article, and this will give you the documents. So if you go through this, you will understand exactly. So you cannot just take a glance at it and know what to do. You have to actually sit down, print it, and try to understand it. Okay. All right. Very good. So it's in Blackboard and for you to pursue. And if you want to take that on after the exam, that is also fine because you have to prepare for the exam as well. Okay. Now we go to the next, which is the balances. Here we have the first assertion, which is completeness. What we have to do here is reconcile the aged trial balance with the subsidiary ledgers and general ledger to ensure accounts receivable was not omitted from the general ledger. What does this mean? You have two documents where all the accounts receivable are listed. The first one is the aged trial balance, which is listing the accounts receivable in different categories such as 30-day old, 60-day old, 90-day old. And then you have subsidiary ledger. Subsidiary ledger is what you just looked at, the accounts receivable for North Supermarket, right? The accounts receivable of North Supermarket. That's a subsidiary ledger. So the subsidiary ledger lists all the accounts receivable under each customer. If you compare the two, if you look at the 30, 60, 90-day old and you compare that with the aged, and if something is missing from one of these two places, that means there is something not completely recorded. Something is missing from the balance. Okay. So by testing, the checking, the comparing of the two will tell you that everything is completely recorded in the balance sheet or not. The next management assertion is existence and rights. This is done through confirmation, and I'm going to talk about this in just a few minutes in detail. This is done through sending letters to the customers of the client, and I'm going to show you the process in just a second. It tests whether the accounts receivable actually is a real accounts receivable, which is existence. The second, it tests the rights, whether the accounts receivable actually belongs to your client or not. Okay, so we're going to test this in just a second. We're going to go through this in just a few minutes. The next thing is checking the valuation and allocation of the accounts receivable by looking at the calculation of allowance. The allowance for uncollectible is calculated based on certain formulas that the client uses, looking at what is the normal collection in the industry, what is the normal collection for the client, what happened in the past. So you do the calculation following those guidelines, and to make sure that the client's calculation is reasonable. If there's any problem, you can discuss with the credit manager, and you can also look at the previous year's amounts. So let's say previous years the allowance was always 5% of the accounts receivable. This year it's only 2%. They have only calculated 2%. So you can discuss with the credit manager that what happened, why is it less, why is it less than half, right? And they might give you a reason. They might tell you, oh, that's a mistake. In that case, they will fix the mistake and move on. Okay, so this is the valuation and allocation of the accounts receivable. Okay, then we have the last one, which is the presentation and disclosure. Classification and understandability is what we're going to test here. Find and reclassify material credits to accounts receivable. Accounts receivable usually has a credit balance. So let's say you have a sale, you record debit accounts receivable, debit to accounts receivable $100, credit to sales $100, right? And then you collect the money, you would have debit to cash 100, credit to accounts receivable 100. This is what will happen. After the first transaction, debit to accounts receivable 100, credit to sales 100, your accounts receivable will show a debit balance of 100. Once the payment is made, your accounts receivable will show a zero balance, because debit 100, credit 100, there should be nothing left. Never should your accounts receivable show a credit balance. But if there is a credit balance, then there is something wrong. There is something wrong. Or there is some misclassification, some other accounts payable, or some other customer's accounts receivable was recorded in your customer's account. So in that case, if it is material meaning if it is a large amount, so sometimes you might find a 50 cents $0.5 or $1 accounts receivable credit, in that case, you don't worry about that because it's insignificant. But if it is material, if it is a large amount, and what is large depends on the size of the client, right? If it's $1 billion client, maybe $1,000, maybe even insignificant, right? So you have to see what is material, and then ask the client to reclassify, to move those amounts to the right account. Does that make sense? Do you follow? Then you segregate the short-term and the long-term receivables. So all account receivables are short-term. If there are other long-term receivables such as note receivables and other things got misclassified as accounts receivable, then you have to ask the client to reclassify and fix it. And then ensure different types of receivables are classified properly. The other types of receivables could be officer accounts receivable or related party receivable or notes receivable. They should be classified in the right account and not mixed with the accounts receivable. Those other types of receivables are usually few, and the client may not even have any. The main receivable that you're worried about in the revenue process, in the revenue cycle, is the accounts receivable. Okay, and you want to make sure that it's classified properly. Clear? Are you following? Are you with me? Okay, now let's jump into the accounts receivable. Confirmation. Accounts receivable confirmation is done by sending letters to the client's customers, and you wait for them to respond to see whether the balance is accurate or not. So this is done almost all the time with very few exceptions. What are the exceptions? The exception is if the accounts receivable is immaterial. So let's say the client mostly has cash sales and not accounts receivable sales, credit sales, in which case you should not necessarily do the confirmation. If you feel that the confirmation would not be effective, so you might send letters to the customers of your client and the customers won't respond, or there is very low chance of you getting the letters back, in which case it's not effective, and you don't want to do that. The third is if the inherent risk and control risk are low and other substantive procedures related to accounts receivable suggest that there is low risk in the accounts receivable account, then you can also skip, you can omit the confirmation of accounts receivable. So in this case, if you go and you see that, okay, the client has a very good system of recording the accounts receivable, their accounts receivable collection and recording is very sophisticated, and they're always on time, and their customers are very good, and their controls are super. You're very happy with the process, and you don't think that there will be a big mistake in the accounts receivable. In this case, you can skip the accounts receivable confirmation. Now, these situations that I've just described to you in this slide, they're rare. You might go through a 25 years of auditing career and may never find a situation where you skip the accounts receivable confirmation. It is possible, right? So accounts receivable confirmations are very, very common, and they're always done. Okay, are you following? Are you with me? How to do that? How do you do this? So let's go to our accounts. Here we have again our friend North Supermarket, which is a customer of our client. What is the name of our client in this example? What is the name of our client? Let me see who remembers. Men and boys, very good, Sharat. Excellent. So we have a North Supermarket. The balance is, you see, 1,750. So you see what happened. North Supermarket made a purchase on December 7th for $1,615. Another purchase on December 20th for $1,750. But on December 14th, North Supermarket paid, right? So they made a payment, as you see, $1,650. They made a payment, so accounts receivable is credited. That means they have a balance of 1750 December 31st. So what we want to do is we want to send a letter to North Supermarket asking them if this balance is accurate or not. So let's take a look at that letter, how that letter looks like. Here is the letter. The letter reads, the letter is from your company. The name of your company is Adam and Associates. All right. So look at the date. It says January 3rd, right? So you're sending the letter on January 3rd. I will come back to the date in just a minute, why that date is important. So you're writing to the accounting department of North Supermarket, and you're saying, dear sir, we are working in the capacity of independent external auditors for Men and Boys Incorporated. The records indicate that as of December 31st, 2015, there was an accounts receivable from your company. Please notify us whether you agree or disagree with the amount stated below. If you disagree, please provide us with the correct amount based on your records. So this is coming from Sam Shafi, who's the senior manager of the audit. Okay, are you following? So the client responds at the bottom of this letter. You see the client says that I disagree. This is the accounts payable supervisor of the client's customer, right? The client's customer. So this person says, I disagree. The correct balance is 0. So now there's a problem. The client says 1750, but the customer of the client says 0. Are you following? So this needs further investigation to see who's correct. Okay, so this you separate. If you have a situation where the customer of the client said, I agree, for instance, here, in the case of West Supermarket, the customer says, I agree. In this case, this is not a misstatement. There is no problem here, right? So you identify those that have a problem, and if you see that there is an error, you do the calculation using our tolerable and our expected and all of that we did before, right? Every time you have a misstatement, then you do the calculation based on the number of misstatements you have. You project that onto the population just as we discussed before, and you come to the conclusion. All right, are you following? So this is how we do the accounts receivable confirmations. Okay, okay, let's come back to our slides. What we have here is there are two types of confirmations, positive and negative. The one that you looked at was a positive confirmation where we asked the client's customer to respond yes or no. If they agree, respond. If they don't agree, also respond, right? And we do that for large accounts. There is another type of confirmation which is negative, which means you ask the customers of your client to only respond if they disagree. If they agree, no need to respond. If they agree with what you asked, what you said as the balance was, then no need to respond. But the problem here is that this is usually done for small amounts, right? Small amounts, small accounts. But the problem with this is that if the client's customer did not respond, you don't know whether it is because they agree or they never got the letter or they never read the letter. You follow, right? So this is a problem with the negative confirmations, but usually it is done for small amounts. So even if they don't respond, you're not going to have a big mistake in those small accounts. All right. The timing of these letters is the first, it can be done in the middle of the year. You can do it somewhere in the middle of the year, September, October, something like that. But if you do it immediately after year end, you can get good results. Now, let me see who can remember what was the date on the confirmation letter. What date was it written? Let me see who can remember. I showed it to you and I asked you to remember the date. What was the date on the confirmation letter? January 3rd. Very good, January 3rd, which is immediately after year end, right? December 31st year ends, January 3rd. That means this is good practice. All right? This is good practice from whom? This is a good practice from whom? Who writes that letter? The audit firm. Very good. The auditors, right? The auditors write that letter. So this is what you're supposed to do. Do it very quickly so that you can get quick responses. All right? Any questions so far about the confirmations? What we are after when we do the confirmations? Okay, we will come to that. What if they don't respond? We will come to that. But do you understand so far? Okay, so let's go and see what happens. Uh, we send these letters from outside the client's office. So when you're in the client's office, you're going through their records, you're doing the audit. When you write these letters, they should be from your office and not the client's office. You should write these letters from your own office. You go back to your office and you write those letters and you send them from your office. You never write those letters in your client's office and you give it to them that can you put it in the post. Never do that, right? This is something that you never do. So you send it from your office, not the client's office. If the client's customers do not respond, send a second request. Okay, send a second request. If you send a second request, usually you get some more responses. And then when you get the responses, examine the reason for each difference. So if the customer agrees, no problem. If you find a customer that does not agree, you go back to the records and see why they don't agree, who's right and who's wrong. If your customer is right, if the customer is right, or your client is right. If you don't get many confirmation letters back for you to calculate with a sample, then you can examine number one, subsequent cash receipts. For example, in December 31st, if the accounts receivable was $1,750, if you find a payment from the same customer coming to the client in January, so the client's customer is making a payment for the same amount in January, that means the accounts receivable was correct. It was correctly recorded, right? So subsequent cash receipts mean the payment for that accounts receivable is received in the following month. Do you follow? Ali, does that answer your question? Okay. If uh, that is not there, then you can look at these other documents, right? Customer order, shipping documents, invoice, or any other related document to see whether you can be satisfied with the amount they have recorded. If anything that will prove to you that that amount is correct. And again, you cannot look at look at all the amounts, all the balances. You look at it, you look at a sample. You look at a sample of balances and you confirm and these other procedures to make sure that the entire accounts receivable balance uh, is reasonable. So you can give an opinion on whether the accounts receivable balance is fairly stated or not. Clear? So this is the end of the accounts receivable audit. For other receivables, such as officers and employee receivables, related party receivables, and notes receivables, these are very few and you can confirm them usually very easily. If they are large amounts, you can pursue and confirm them and make sure that they are correct. There's a question here. Uh, do you ever go physically if they don't respond to the request? The thing is, you don't have time to visit 93 customers. If your sample was 93, remember our sample was 93 and 78, you have a life, you remember, you have a life as an auditor. If you're driving around for 3 weeks, going from customer to customer, asking them, you don't have time. You don't even have time to call every one of them. You follow? Your time is very precious and your time is very expensive. Very expensive. You follow? So when I was a manager, for example, when I left, I was a manager and my time was $150 per hour. I did not get paid that, but the client was billed $150 for every hour. You do the math, right? $150 times 8 hours, right? How much is that? $1,200 per day, right? Which is how many reals? How many reals? 1,200 times 3.65, right? So it is, that's one day, right? Do the math, right? If I drive around for a week, right? I drive around for a week, 4,200 times, let's say 5 days. How much is that, right? So, you know, I don't have time for that. You follow what I'm saying? The client cannot pay me to do that kind of audit. Do you follow? So I don't have time to do that. Neither do you have time to do that, right? Your time is expensive, and it is good that your time is expensive. You follow what I'm saying, right? It's hard work, but it's worth your time, inshallah. Any questions? How long does it take to do this? It takes a few weeks, right? A couple of months, 3 months maximum. And remember, you're not usually working on one audit at a time, right? Multiple audits are going on, and if you're a senior manager, you're supervising multiple audits. If you are as an associate just joined, you will work on one audit at a time because you're learning and you're not going to move around. But even then, you could work on multiple audits, right? So multiple audits are going on, multiple people are working on the same audit, right? So you have to keep track. You have to be very organized with your time. Very organized with your time. I remember, and I was not working on audits. We did something called compilation, which is uh, other comprehensive engagement. But it also, and it's similar to, it's all dealing with the financial statements and looking at the accuracy and so forth. But I remember during the busy season, which is right now, during the busy season, I would work uh, 6 or 7 days a week, 14-hour days sometimes. You know, I go there 7 o'clock in the morning and work until 7, 8, 9, sometimes 10 o'clock at night. You know, continuous work. And the issue is, you can find many accountants, but you cannot find many accountants who are CPAs who can sign on the report, right? So if you can get one of these designations, you can become a CPA or ACCA, then your time becomes even more expensive, right? You become even more expensive. So uh, go for one of those certifications, CPA or ACCA, and you know your value is going to be. And remember, when you have one of those designations, it doesn't matter where you graduated from. You passing the CPA exam or the ACCA exam, and a student who graduated from Harvard or Oxford uh, passing the CPA or the ACCA exam, as soon as you both pass those exams, you are equal, right? It doesn't matter anymore where you graduated from. Are you following? So in the profession of accounting, right? In the profession of accounting, you have the opportunity to upgrade yourself. And remember, those exams are difficult, and that's why they are so valuable. So if everybody could pass them, right, like everybody will pass this course, inshallah, then they would not be that valuable, right? So you can do any one of these, ACCA or CPA. You can do any one of these exams from Gulf, right? Some of them may not be in Qatar, for example. You might have to fly to Dubai or so forth, some other place to take the exam, but you can take all of these exams. There's a question: how do people manage to do these designations amid this such hectic schedule? You just have to do, right? That's why only a few people can do. So those who can do, they will go ahead in their career. They will excel. They will be on the top rank. Not everybody can do. It's difficult to do, and not everybody can do. And that's why if you do, you become more valuable. Does that make sense? If everybody, it was easy to do, everybody would do, and it would not be that valuable anymore. Does that make sense? Right? You know, I remember sitting in the uh, CPA review class, the class that would prepare me for the CPA exam. I was taking it in my final semester, so I would have, you know, regular courses throughout the week, and I was also working, so I would have throughout the week regular courses and so forth. And then at the end of the week on Saturday, I would go to this course, CPA review course. It was 8 hours from 8 o'clock in the morning until 5 o'clock in the afternoon, 8 hours of preparing with them, and they would give us homework that would take about 20 hours or so throughout the week. So before we came the next week, we would have to do this homework. So spend 3 hours on an average per day. And I remember my time for that was I would finish everything for the university and all of that, and then I would sit at 9 o'clock, and from 9 o'clock until 12 o'clock or 1 o'clock at night, I would prepare for the CPA exam. And I did that for 3 or 4 months. And again, you don't have any life other than doing this. Very difficult. And I remember from that CPA review course, after a couple of weeks of that course, the students that were in that course, many of them said that, you know, I'm just not going to do this. This is just too much. It's just, you know, putting too much pressure on me. I will attend the courses, but I'll just go in the CPA exam and see how the exam is like, you know. So this is what happens. So I'm encouraging you, I'm telling you that it is difficult, but I'm encouraging you to do it, because if you're able to do, then you will be in the top rank. Okay? Any other questions? Our plan is that we're going to review for the midterm exam on Sunday. I'm going to tell you about the exam, the types of questions, etc., etc. You study chapters 8, 9, and 10 over the weekend, and if you have any questions, you can ask me on Sunday. Also, Tuesday, I will have the session for Q&A from you. So I will not start chapter 11 until next Thursday, which is after the midterm exam. When is the midterm exam? When is the midterm exam? Wednesday, February 24th. Very good. All right. I will see you on Sunday, inshallah. We'll do review on Sunday. Assalamu alaikum wa rahmatullahi wa